with me right now is Charles Nedoss of Olympus Futures. He actively trades stock, grains, and metals. Also with us is Jan Loeys. He's Managing Director and Head of Global Market Strategy at JPMorgan. And Jan, let's start with you. You're just back from being overseas. How would you describe the global market environment at this point?
Well, not that great. It's a slowing growth environment. I mean, we've done a decent past year, about a percentage point faster than potential. We're facing now a year where we're barely going to grow at potential, so it's very disinflationary. Doesn't show much upside on equities, and it's going to create a lot of attention for any security that pays income.
Well, it's interesting. You talk about security and a lot of attention. I think a lot of that's right now on Deutsche Bank today with the news that it looks like they might be possibly looking to raise as much as $11 billion U.S. It could be for acquisitions. It could be to meet Basel III requirements. I mean, a reminder that it's going to be a very different environment potentially for these financials going forward. And Deutsche Bank is supposed to be the strong one in terms of the European banks.
But overall, European banks are less well capitalized than the U.S. ones. So the banks do not face a growth environment anymore. They face a slowing environment for them. So the important thing for the banks to sell their securities is to offer good yield, good dividend overall. That's the problem now for the banks.
And Matt, I want to bring you into this conversation. I know you're out there and you're listening to us.
Yeah, well, you know, Steve and I have been talking about this all day, ever since at least the news broke on Deutsche Bank. And it's interesting because I think, and let me ask you, Jan, Steve and I were saying this offers really one more piece to the puzzle, a little bit more certainty. At least, you know, the situation is going to get better for them as far as liquidity and capital.
Yes, that's great certainty for the bond investors. It's not that great for the equity investors. We're going to see a lot more supply in the financial industry. So if you're an investor and you have a choice, go for the bonds of the banks, not so much the equities.
All right, got a few seconds before the bell. Charlie Nedoss, I want to bring you into this. That Deutsche Bank news, it did bring down the market trade. How significant are you guys potentially seeing this, the news out of Deutsche Bank?
I think Deutsche Bank just adds a little bit more uncertainty to the market here in terms of that situation and trying to figure out what their strategy is. I think it also could lead to more assumptions that there's more skeletons in the closet in the European banks, and puts their financial situation again further under the microscope to find out if there's any data points that we've really been missing.
All right, and go ahead.
No, I was going to say in terms of market action here today, I mean, you put in most of the range here in between 7:30 and 8:30 Chicago time after the unemployment numbers, or the employment numbers, and the trade balance numbers. Other than that, you just really chopped around. If you look at the day as a whole, we rode the range in between the 100-day and the 200-day moving average.
Okay.
No, I was going to say since about a week and a half ago when we tested the lows back at the 1040 area, we have put on a lot in terms of price, and I think we're going to see some more good news out here and really some more volume in terms of conviction to take us above the 200-day, which we stalled out on today.
I want to get back to Jan Loeys right now and continue on the topic of Deutsche Bank, because it seems like everybody understands the problem of overhang is a negative for a stock when you hear about a share sale. But, when we saw the U.S. banks capitalize, their stock kept on rising. Isn't this possibly good news in the medium to long term for Deutsche and for any other banks that jump on board and do the same?
It's good for their business. It's good for their credit quality. But as with Deutsche, basically the question is obviously if they have to raise capital, how much do the other ones have to raise? And we know the Europeans are behind with respect to American banks on capital raising. So I do think you want to prefer the U.S. banks over here.
And Jan, we've been so worried about transparency issues when it comes to those European banks, whether or not the stress test really gave an accurate picture. You're smiling. Did you not think that they did?
It was a bit better than most of us thought. So
not reality then?
They're a bit better than reality, yes.
A bit better than reality.
I wonder, let me jump in here because, Steve, it seems to me you could look at it as, oh, God, if this is so bad that Deutsche Bank has to raise capital, how bad is it for them? Or you could look at it as if Deutsche Bank is getting a huge head start here on everybody else.
I would take the latter. I think it's short-term negative for equity holders. They got to get through it. Mid to longer term, I think it's a very positive step. It's the step that we've been talking about for months that they have to do. As you said, the U.S. banks did it. They're going to probably have to do another second stage. But this is the whole liquefying process that we've been saying for the last 6 months to a year, that it's going to take time as we get through this. We have to take the pain, but we will get through it. It'll be fine.
Hey, Charles, it's Dominic here. Just to get you into this conversation, we were looking at the charts, Adam and I, and talking about this idea that the S&P, from a very simplistic view, technically speaking, cannot seem to get above this 50-day moving average, this shorter-term batting average, if you will, for the market. It hasn't been above it since May. How much are technicals or chart watching playing into what's going on here? People talking about this range-bound market, right?
I think a lot. I think the 1140 was a key area for the market to hold about a week and a half ago. We came up, and again today we spent most of the time in between the 100 and the 200-day moving average. So again, I think that you're going to need really some conviction in terms of volume and in terms of good news to push this thing higher. Matt, if you look, you're talking about earnings and we're talking about, the employment situation. Yeah, today was a bright spot in terms of the weekly numbers. But if you look at the bigger picture, we lost 8.5 million jobs. If you look at the continuing claims number, which was a little positive today in the sense that it was down, but you're still at 4.4 million roughly, okay? Now, let's say that the economy's added back 775,000 jobs. That means you've got 3 to 3.5 million people that are still floating around there in limbo. I don't think those people are going to be out spending, buying new houses, buying cars, and buying flat screens. So, again, where do we go from here? We've seen the inventory replenishing phase of the recovery, but again, what's going to lift us further? And I think that's, again, the uncertainty that hangs over the market here looking forward.
Well, I got to go back to an earlier guest, David Stockman, the former OMB budget director under President Obama, and, he paints a pretty ominous picture in terms, under Reagan. Thank you, Matt.
Voodoo economics.
In terms of the future, though, specifically the deficit.
That was Bush.
I'm sorry, Matt.
Someone said voodoo economics. We're getting all of our presidents confused, right? You've got Obama now. Voodoo economics was Bush, and then Reagan was Stockman.
Okay, we'll do the history lesson in a moment. I guess my point is, his point was that the problems we have, they're long-term. They're not going to go quickly. Whether you look at the job picture, you look at the booming deficit, or ballooning deficit, I should say, in the government. Jan, let me just give you a few seconds here. Until we deal with these major structural problems, whether it's over in Europe where we keep pointing the finger or over here, right, in our home base here, nothing's going to get significantly better, is it?
Hopefully it will be, but it's certainty
But we have to deal with those problems.
You have to deal with it, and more importantly, we won't know what the solution is or what the outcome on this is. I think a lot of investors who are looking at equities recognize that equities are cheap, meaning they offer you a massive risk premium.
Right.
But that's a compensation for the high uncertainty we have, which is not going to get resolved in several years. So I think basically I agree with the view. Equities are in a range.
All right, we're going to have to leave it there. Jan Loeys of JPMorgan, thank you so much for coming in. Charlie Nedoss of Olympus Futures out there in Chicago. I know Steve Kroll's been working us through this as well.